Markets have enjoyed a fantastic 2024 on the back of expected Federal Reserve rate rises, and those rate rises have been dangling out in front of the market like a carrot, enticing us further and further. Now that carrot is within reach, so what's going to happen from here? Hi there everyone, welcome to the Traders Circle weekly market update. Today is Tuesday the 27th of August 2024, and before I get started, you do need to be aware that whatever I say is general advice only, and you have to consider whether it's appropriate for you. Alright, so let's start with the Federal Reserve. Last week was all about the Fed. They had their Jackson Hole Policy Symposium. They went to one of the more beautiful parts of America. They wined and dined and chatted amongst themselves and came out with basically the same content as Jerome's been having in every one of his recent speeches. They basically said they're going to cut next month, almost guaranteed to be 0.25% cut. The market's been jumping over itself hand and fist to price in more cuts, but probably going to be 0.25%. And they did say that the bar would be fairly low for further cuts. And I think they're really responding to the movements of the market at the start of August, where we saw extreme volatility, very, very rapid correction. We saw Japan's worst day in really ever. And that was all on the back of, one, recession fears in the US, and then two, perhaps the divergence between, Japan's interest rates going higher, US interest rates going lower. So the Fed really has basically come out trying to calm the market, trying to, remind the market that we got your back, we're insuring the market, we're insuring your shares, we're not going to let them go down too much, because if the market does weaken, we'll take action to sort of support it. And they obviously replaced the word market there with economy in their speeches and whatnot. But I do think they really have to be cognizant of the fact that if they are too aggressive, there's no guarantee we won't see reinflation or inflation ticking back up. And I've got a few thoughts on that. I think one of the biggest drivers behind inflation has been money printing, and we're actually going through one of the biggest periods of money printing in human history, with the US government deficit as large as it is. But regardless, the Fed basically did whatever they could, or said whatever they could, that could be as most positive for the market, and we did see the market mostly push higher last week. It did sort of stall out on Thursday, tried to go back up on Friday, and then stalled out a bit overnight. So it'll be interesting to see what happens this week, whether they can push back higher, back beyond and into fresh all-time highs. Moving forwards, we are, like I said, expecting to see a Federal Reserve rate cut in September, and there's been a lot of debate about whether that'll be a positive or negative thing for the market. So what I've got here is a chart of the US Federal Reserve funds rate, or the official interest rate, since the turn of the millennia, and that's in blue. And I've also got the US share market index, or a share market index for the US, and that's in red. And there have been three notable periods of interest rate cuts during that time, during the last 24 years. And those are these periods here. So we can see there was one around 2001, 2001, this one around 2007, 2008, and there was one during the COVID period. During each of these periods, we saw the market move lower. And now I do want to sort of caveat that and say there were recessions within each of these periods, and that does have a bearing, obviously, over whether the market moves lower. It didn't move lower for the entirety consistently during the interest rate cut cycles, and obviously the magnitude at which prices fell was different depending on the period as well. The keen-eyed amongst you will say, well, you only started in the year 2000. What happened before then? Before then, things were actually quite a bit different. So we actually did see prices move higher during periods of rate cutting before the year 2000, most notably in the 90s and also in the 80s. We saw periods of strong share market gains while interest rates were cut. The reason I didn't include them is there's a few reasons, to be honest. One, it's the correlation between market movements and interest rate movements is a little less clear during those periods. I would say there's perhaps no correlation at all. And then the second reason is that outside of perhaps a little bit of very high prices in the early 90s, around 1991, 1992, by and large shares were an order of magnitude cheaper back then than they are now relative to earnings. Back then, the average price to earnings was probably somewhere between 11 to sort of 16 times earnings, and now we're up at sort of 25, 26 times earnings. So shares are significantly more expensive now than they were back during those periods. In fact, shares, by my estimation, shares are now the most expensive they've been outside of 3 notable periods. And those are actually the 3 periods that we see on our chart here. It's the dot-com bubble, where shares were more expensive than they are now. It's the GFC period, where a big downgrade to earnings led to shares being more expensive than they are now. And it's the COVID period, where again, a big downgrade to earnings, a big one-off hit to earnings, led to shares being more expensive than they are now. And so outside of these 3 periods, by my estimation, shares are probably as expensive as they've ever been, if not the most expensive. So look, whether this tells us much is impossible to say. I suspect, whether we see a big downwards revision, as is illustrated in these periods, will come down to whether we see a recession. And if we do, I think there is room to the downside from a longer term perspective for US shares. Moving on. Earnings is the next thing to talk about this week. We're wrapping up the Australian company earnings reporting season, and we're wrapping it up with some big resource stocks reporting this week. Today we saw BHP and Woodside, both are up quite strongly after their reports. Tomorrow we've got Fortescue, and I think importantly for these stocks, their reports have actually coincided with a bit of a rebound in their key commodities, but they have all rallied after their reports. I suspect part of that is because of how much they've been sold down into their reports. We also saw Rio rise after its report. And, BHP and Rio's report, they weren't anything special, yet the share prices pushed higher. I suspect that's partly due to the fact they've been so oversold heading into the reports. As a result, I suspect Fortescue's report tomorrow will have a fairly low bar to clear with regards to upwards movement. If they do match analysts' expectations, I suspect we'll see some upwards momentum in Fortescue. Whether or not we're going to see continued upwards movement in those iron ore stocks, in those material stocks, is going to come down to whether we see those commodities, iron ore and the like, continue to move higher. If you read the commentary out there, a lot of analysts aren't very optimistic about that. Chinese economic data has been quite weak. And you can read through, the Financial Review, many other newspapers. There's lots being said about fairly negative outlook for iron ore, for lithium, for some of these other key commodities. I will caveat that by saying that in the past, those analysts have been quite spectacularly wrong. You can look back to 2015, 2016, they were wrong then. You can look back to 2018, 19, they were quite wrong then. And oftentimes when they have called further selling after a big drop off in iron ore and in some cases in other commodities, particularly most notably in lithium a few years ago as well, they have been quite wrong. So just a big caveat there. But unless we do see a big economic rebound in a few sectors in China, I suspect it'll be hard for iron ore to go too far above 100 US a ton. Finally, it's a big week for data. Just going back to the earnings, I'll sort of go one further on that and say we've also got a very important NVIDIA earnings release tomorrow night, Wednesday night Australian time. A lot of upwards movement in the market has come on the back of a few key technology stocks. A lot of upwards movement has come on the back of strong future earnings growth forecasts based on a belief that AI will trigger massive earnings accretion for large cap US technology stocks or large cap US stocks in general. And the NVIDIA report is going to be very key to that narrative. I think this will be a good report. I think they'll report quite well this time around because it reports for a period previously, a period obviously up until now, where there has been a lot of investment in NVIDIA GPUs. I think the real sort of question will be moving beyond this point. I don't think AI has been quite as earnings accretive immediately as everyone, or at least a lot of these analysts, had predicted. And I think it's going to take a bit more time for a lot of industries to see, positive revenue and earnings growth from AI. But yeah, moving on, there is a lot of data this week. We've got Australian CPI, monthly CPI indicator tomorrow. around 11:30 Australian Eastern Standard Time. If that comes in stronger than expected, I think we're going to start to see more talk about higher for longer and perhaps even another Australian interest rate rise. Going on to Thursday night, we've got US GDP. We've got the first of their PCE price data readings. That's going to be very important. And then on Friday night, we've got the full PCE price report from the US. PCE is the Fed's chosen methodology for looking at inflation. Apparently, they say that, and then, in their statements, they generally refer more to the CPI. But regardless, those readings will be very big for them, as will our CPI reading tomorrow. So a big week for data as well, big week for news and events, big week for reporting and earnings. And like I said, I think there's a fair chance things could look quite different at the end of this week than we look at now. So let's have a look at how we look now, and let's have a look at the charts for this week. So this is the US S&P 500, and it is pretty much back to the all-time high. It is perhaps very slightly below that level. If they do see another notable gain, they will be at the all-time high, maybe even above it, and it's really not too far off the current level. However, if they do dip from here, we're then looking at a lower or inline peak, possibly a double top pattern. And there are some notable levels to watch for on the downside. I think the first target would be 55.50, the low of Thursday last week. If they go below that level, we should see some quite stronger further selling. There is another sort of gap level here at 5,500 that could be a bit of a level. And then 5,400, 5,300 and 5,240, the low from back at the start of the month. If they do go beyond that all-time high, very hard to say how much further they will go. Shares are quite expensive up here, but if we do get an upwards revision to forward earnings estimates, that might allow them to go a little bit further. So we're back at a previous peak for our own market, 80.70. This was our peak back in July. We did push up here. We sort of stalled here and came back off. If we do eclipse this peak, we're then looking at our own all-time high right around 81.50. If we go beyond that, that's a sign of further upwards movement. But if we stall here or at 81.50, it'll either be an inline peak or a lower peak, and that could indicate some downwards movement. For that to be the case, we'd have to break below this short-term uptrend line. If we do, I suspect our first downside target would be 78.70, which is really not too far away when you consider that we've rallied from sort of 76.50 over the past month. So yeah, we're sort of at a key technical level, we're at a key fundamental level, and like I said, I think we could have some questions answered over the next few days. So I will wrap it up there for this week, guys. Hopefully you guys enjoyed. If you did, click like, click subscribe, and we'll see you guys next time. Bye for now.